Jane, thank you very much for coming through. Flower exports down 15% in the last year. How's that impacted on earnings in the sector?
Well, unfortunately, we have seen a dip in terms of the returns, and this is as a result of the very bad climatic conditions that we experienced in 2010, beginning with the ash cloud and then the very adverse weather in Europe towards the end of the year and a drought here in Kenya.
All right, despite some of those exogenous shocks, obviously, we have seen generally an improvement in prices across the commodities spectrum. That must have acted as some sort of a buffer for the horticulture and flower sector. Your expectations for 2011 in terms of pricing?
Well, 2011, we're hoping that we'll have a much better year, of course. We are looking forward to the economy turning around in Europe, therefore encouraging much more expenditure on products such as flowers.
Now, obviously, this segment of the industry, as you expressed earlier, is subject to shocks. The cold snap and the volcano that disrupted flights to Europe. So obviously, at this stage, you should be looking at safety nets, contingencies for the sector.
Yes, indeed. We've learnt a lesson or two, particularly in terms of dealing with the drought. And one of the lessons that we took home is the need for us to do much more water harvesting, invest much more in technology, for instance, to use water much more efficiently and optimally. And we are carrying out studies to see what are the risks, and thereafter to see how do we manage these risks going forward.
I mean, one of the other things you've got to also manage, Jane, is the fact that you can't control events in Europe, for instance. And Kenyan flowers account for 35% of flower sales in Europe. Isn't it time to start thinking about new markets?
That we are doing. We are looking at diversifying our markets, and thankfully the government is working with us on this. And we're exploring markets in Japan, in Eastern Europe, in America, just so that we spread our risks a little bit more.
I mean, just answer me here, Jane. It may sound like a very simple question, but I'm not in the industry. The distance between Kenya and Europe is not so far. So there's not the risk of perishability. But once you start looking further east, there is the whole issue of the flowers might not be so bright and resplendent when they get there. So how are you going to address that issue as you look at new markets, making sure that the goods are not as perishable as would be because of the distance?
Well, we have one advantage. The Kenyan flower is a very high quality flower, and it has very good resistance or resilience in terms of travel. For instance, our volumes into Japan have grown over the last 5 years, mainly because of the fact that the flowers are able to overcome the stress of travel this long distance. And it's all about how the flower is produced, packaged, and handled.
Okay, Europe remains a dominant market and destination for Kenyan flowers, and we know that within Europe there have been sovereign debt woes. We know that there have been very bold steps for austerity, which means that the average European needs to be a little more discerning in terms of how they spend their money. How's that impacting on your particular sales in that region?
What it means is that we have to specifically go out to ensure that we retain our current clientele in terms of meeting their expectations. And what it means is that before they spend their money, they want to be assured that they're spending money on a product that they desire in terms of their expectations of the product. And therefore the quality demands are going up. And we have absolutely no problem in keeping up with the demands. And we're doing a very good job in terms of ensuring that we meet the customer demands on the other side. And this is in terms of the product itself, the diversity of the product, and also they want to know that the products are produced in an environmentally friendly environment, and that even the workers are very well looked after.
Now, agriculture constitutes something like 22% of overall Kenyan GDP, and a substantial chunk comes from the flower sector and horticulture in general. You mentioned the drought, and everybody's starting to be a little concerned about how the drought will impact on production and invariably on prices. How are you dealing with this prospective threat?
Well, as I said a little bit earlier, we did learn a lesson from the last drought, and a lot of farms have conserved a lot of water on their farms. If the drought doesn't go beyond a couple of months, we should be okay in terms of production on the farms. However, this has only signaled that we need to pay much more attention to conservation issues in terms of building up water catchment areas and restoring those that have been depleted, but also contributing to climate change projects that mitigate against the impacts.
I think the question really that I wanted answered, Jane, is that there's a threat of inflation in Kenya, and there's also a need to develop the local consumer market for Kenyan flowers. Are locals going to be buying Kenyan flowers, because the prices might invariably have to rise?
Actually, the local market for flowers has grown substantially over the last couple of years, and although the volumes that are uptaken by our market here are insignificant, it is growing, and it will never be able to substitute our exports. But what it does is that it increases the number of livelihoods that are supported by the industry here in Kenya.